I have just about 2 o'clock here, so we'll just give another second as I see some more people continuing to trickle in. Okay. So we have a number of people still coming in, so I'll give it another moment and hope everybody is having a great day. And we'll begin here in just about another 20 seconds or so. Okay. I see a number of folks that have signed in. So why don't we go ahead and get started today? First and foremost, I wanted to thank everybody here for their time today. Hopefully, you'll find today's presentation interesting on a number of different topics. So we'll cover just the basics of alternative investments, and while that might be somewhat basic for many of you on the phone today, I think it's important to highlight some of the characteristics that really were the backbone and the rationale why I started MJ REIT a few years back and the opportunity that we're looking to take advantage of. And so, by way of introduction, my name is Chris Reese. I'm the CEO and founder of MJ REIT, and I've been in the asset management space for almost 30 years now. Half of those on the public side, and the last 14 years spent on the private markets side. Along the way, I had the pleasure of working with a firm that launched the first private BDC, which stands for Business Development Company. And that BDC was really designed to facilitate the flow of capital to either private or US companies. And the firm was very successful and raised a bunch of money and made loans to thousands of companies in the United States. And when I left, I looked at that particular strategy and why it was so successful. And I looked at a number of different industries in America. And some of those were infrastructure, oil and gas, even crypto. And I kept coming back to cannabis as one of those areas that has a high growth rate, a limited amount of capital, and limited institutional involvement. So after about 6 months of going back and forth with the regulators, MJ REIT was launched in August of 22. So our first full month of performance, as we go through, and we'll see in a moment, was in September of 2022. So with that as a backdrop and a quick introduction, first and foremost, this presentation is intended to be informational only. It's not intended to sell, and certainly past performance is not indicative of future results. So please read the PPM before considering any investment in the portfolio. All right, so with the disclosures out of the way, what's our objectives today? And I really outlined 4 main objectives that we'll cover in the presentation today. So as I mentioned, a little bit of background on the alternative universe overall, and then we'll shift and focus on specifically on real estate within the alternative universe and how that real estate can help with portfolio diversification. And then we're going to transition to get even a little bit more micro focused, and we'll look at the areas of what I refer to as specialty real estate. And then we'll spend the last 10 or 15 minutes going through how MJ REIT may make sense for your portfolio. And we'll answer some questions, hopefully throughout today's presentation. If I don't cover those questions during the presentation today, I'll save some time at the end to make sure we answer all of those questions. So when you take a step back and you look at this notion of private versus public companies, and I mentioned earlier in my opening remarks that I spent half of my career on the public side and the other half on the private side. But interestingly, if you were to look at just private companies in the United States overall, so regardless of size, about 96% of the entire company universe is actually private. And often when I say a statistic like that, I usually have somebody that pushes back and says, well, a lot of those are mom and pop shops that aren't generating really any significant revenue. And that's fair. So the chart I have on the left-hand side, what I did was I took a look at all the companies in the United States that had revenue on an annual basis greater than $100 million. And if you look at that universe, you would still see that 86% of those companies are private, while only 14% of those are public. Said differently, if you are investing only in that public sector, whether it be public stocks or public bonds, what you would essentially be missing out on is 86% of the opportunity in the marketplace. And then just to continue with that point, if you look at really the major large companies, the big cap companies, where they have revenues of greater than $1 billion, and this is on the right-hand side towards the bottom, So companies with revenues greater than $1 billion, that represents 18% of the overall companies in the United States. But interestingly, if you look at that, 11% of those are private and only 7% are public. So again, even on the super large companies, still see that there's a huge amount of private companies in the marketplace. So why should you consider alternative investments? For me, it really comes down to three basic reasons. The first is diversification. Second is volatility. And lastly is the potential for return enhancements. And we'll go through each one of these components as we proceed through the presentation today, and I'll kind of highlight the benefits and risks in each one of these. So I wanted to share, and I don't know if anybody's read any of their material. There's a group called Tiger 21, and Tiger 21 is a group of individuals that have a minimum net worth of $5 million of investable assets. And once a quarter, they compile their member allocation. And what I thought was interesting and what I wanted to share with you today is kind of along the same vein of looking at the private versus public. If you look at how these members have their allocation towards public stocks or bonds, you'll see that combined, the public stock and bond market represents only 30% of their overall allocation, while alternatives, on the other hand, represent almost 60% when you factor in real estate, private equity, hedge funds, commodities, and currencies. So the point being, if you look at this area and use it as a proxy to how the ultra wealthy are investing, you'll see that the vast majority of their assets are tied up in non-public securities, whether that be real estate, et cetera. So interesting to take a look at and take a lesson from. So what's the opportunity in the real estate market? So this is kind of the second part of the presentation. And real estate overall is an enormous area of the US economy. And that comes probably as no surprise to everybody on the line today. If you look at real estate, it's third largest behind fixed income, which is the largest at 54 trillion, stocks, public stocks at 49 trillion, and then commercial real estate comes in third at about $24 trillion. But unlike fixed income and stocks, the benefit with commercial real estate is it gives you the income associated with the fixed income portfolio, as well as the growth associated with an equity portfolio. So within private real estate and private commercial real estate, what you're getting is both income and growth orientation within an investment. So for us, it was an attractive area to look at this space and say, this is a spot that we can generate not only consistent income, but also the potential for growth overall. And similar to what we saw in the public companies versus private and the opening slide, I looked at how really do investors gain access to the commercial real estate market. And if you look at the private opportunities versus the public, 96% of the opportunity is private, while only 6% is held in public REITs. So said differently, again, similar to what the concept was on public versus private on the company side, it's the same way here in the private side. But if you look at how individual investors typically allocate to private real estate, and that's shown on the right-hand side, institutional clients tend to have above 10% of their portfolio allocated to private real estate. But if you look on the investor, which is the blue bar on the bottom right, generally speaking, individual investors have less than 3% of their portfolio dedicated to private commercial real estate. So there's an enormous opportunity, and we're going to continue to talk a little bit more about that today. One of the big benefits, and there are several, but one of the big benefits with real estate is that historically speaking, real estate has been a solid hedge against inflation. We had some recent inflation numbers that came out not too long ago suggesting that inflation is hotter than first thought. And we don't really know the impact of future tariffs or even some of the deportation and what impact that will have to you and I as consumers, and will that spark inflation? Well, the good news is real estate has generally outperformed that because it's a hedge. Because if you look at the bottom, when you see higher inflation, generally you'll see the ability to raise rents and you see appreciation in the underlying assets. So it's been a great hedge on the inflation side, and it's been consistent with its income approach. So here I took a look at the last 20 years, and these numbers may seem a little low, but keep in mind, this is for the general broad-based private real estate market. If you were to look at on an annual basis what the distribution was Out of those 20 years, 16 of those years, the distribution was 4% or greater. If you look at the very bottom, interestingly, in every one of those instances, we never had a year where the distribution was less than 3% in the real estate market. Now, again, this is broad-based real estate. When we transition and take a little bit of a deeper look at specialty real estate, these income levels can grow substantially from the numbers that you see on the screen. So what is that opportunity that we see in specialty real estate? So just to define what I refer to when I talk about specialty real estate, it's really any real estate market that's not the broad-based multifamily residential office. It's these little niche areas of the market like historical buildings, medical practices, movie theaters, even data centers. That's the very hot area of the market as well. And included in that is cannabis. And that's where I'm going to spend pretty much the majority of our time today, really focusing on this area of cannabis and the opportunities specific in the real estate space. If you look at cannabis overall, there are three unique characteristics that you really don't find prevalent in most other areas of the real estate market. You might find one or two, but not all three of these. And when you can find a market that has these three characteristics, generally it's an opportunity for investors to generate better risk-adjusted returns. So the first is strong growth characteristics. If you look at cannabis overall, cannabis remains one of the fastest growing sectors within the US economy. Lack of traditional financing. So because cannabis is still illegal at the federal level, banks aren't active in lending into the cannabis space. So you have strong growth and you have a lack of traditional financing. And the third characteristic, which is unique to this space, is that there is limited institutional involvement. So if you have strong growth, you have lack of capital to fund that growth, and you have lack of institutions to pile into this area of the market, it creates an opportunity for individuals to take advantage of this disconnect between strong growth and lack of capital. And that's exactly what we do at MJ REIT. From a fundamental standpoint, all we do is step in and finance a piece of commercial real estate, and we don't even touch the plant. We're not lending directly to an operator, but we simply finance a piece of commercial real estate whereby you, the owner, have a cannabis tenant. And because of that cannabis tenant, you can't go to Wells Fargo or JP Morgan and get a mortgage on your property. So that's all we focus on within MJ REIT. And from a migration standpoint, I really like this chart because I think it does a great job of showing visually the expansion of cannabis over the decades. So I start on the left-hand side in the year 2000. So we had, at that point, we had about 6 states that were medically legal. And it all started with California back in 1996. And as you scan your eyes from left to right, in the middle, I show 2010, where again, we're still only medical, but you see the more and more states continue to pop up. And then finally, if you look at the right-hand side, you'll see almost every state except for 9 of them, actually have at least adult use or medical cannabis available for their citizens. So why is this important? So one of the unique aspects that's prevalent in the cannabis space is that when a state goes from either 0 to medical or from medical to adult use, you can't cross state lines with cannabis. So for example, when you look at the state of Texas, when they begin their medical program, any cannabis consumed needs to be grown and processed within the state of Texas. And then when you go from medical, which is generally the case, to what I'll refer to as adult use or recreational, you see the total addressable market expand significantly, and that creates a lot of opportunity. In the cannabis space, it's all regulated on a state-by-state basis, meaning that you can't just go and randomly open a cannabis dispensary or a cannabis cultivation. You need to be licensed and sanctioned by the state, and that sanction is to a specific address that's recorded in the municipality. So what that means is you can't just all of a sudden pop up and see 20 or 30 dispensaries open right around where your dispensary is located. So there's barriers to entry, which for us create a specific risk mitigation for all of our investors. From a total sales standpoint, cannabis continues to exceed expectations. In 2024, we'll have 12 states that generate more than $1 billion in sales, with the state of California by far the highest at just about $5 billion in total sales. And for those states that don't have a program, if you're a governor and you're looking to fill the tax void, it's tough to raise taxes on your citizens. But if you legalize cannabis, well, that creates a lot of additional tax revenue that can be used for social programs. It can be used for roads or schools. And that's exactly what most of these states have done. The state of Pennsylvania, for example, if you look at Pennsylvania, well, we're only medical at this time. 5 of the 6 bordering states have an adult use program. And the governor of Pennsylvania last week in his budget address made mention that he spoke with dispensaries in Ohio, New York, New Jersey, and Maryland. And over 60% of customers are actually residing in Pennsylvania. So if you're the governor, your citizens are going to go across the bridge, spend money in New Jersey or Ohio or in a bordering state. That state collects the tax revenue and Pennsylvania doesn't. So you have a natural incentive to continue to see these expand over time. And that's exactly what we've seen going back from the start in 1996 through where we are today. And I suspect that in Pennsylvania, there's a movement that by mid-year, Governor Shapiro will get that passed, and ultimately sales would begin targeted in early 2026. And from a sales standpoint, we continue to see a nice pickup in national sales. So if you focus your eyes for a second on the bottom part of the bars, the black area, that's actual sales or forecasted sales specifically within cannabis. So in 2024, we'll be right around $32 billion, and that grows to just under 60 by the year 2030. But importantly, if you look at the remainder blue area of those bars, that's the additional economic impact through somebody that works in a cannabis dispensary or cultivation and their ability, or what we'll call multiplier, to take their current salary and spend it on food, shelter, clothing, and that multiplier effect comes up over $100 billion in 2024 and doubles to more than $200 billion by the year 2030, at least from an estimation standpoint. So cannabis is a very, very large market, and we have no reason to believe that it's going back anytime soon. We talked a little bit about the growth in the cannabis area, so I want to spend just a quick second on the lack of financing. And this is critical because this is really what gives us the advantage in the marketplace. The chart on the left-hand side, I start with the total number of banks in the United States. So we have just over 4,577 banks that are currently active in the U.S. 563 of those accept cannabis deposits. So let's assume you're an operator and you have monthly sales you take and you can deposit that cash with that bank. But if you keep going to the right, you'll see that banks making loans to cannabis, I have at 50, less than 50. It's actually closer to 25. So the options out there to get a loan or to get a balance sheet advance is just simply not prevalent in the market today. And it's that demand coupled with the lack of financing that gives MJ REIT our advantage in the marketplace. And then from an institutional ownership standpoint, I thought a good way to show the lack of institutional ownership would be to look at the top tobacco and alcohol stocks and look at the institutional ownership there versus the institutional ownership for what's referred to as an MSO, which is a multi-state operator. So on the tobacco alcohol stocks, if you look at the institutional ownership, you have about 75% of the outstanding shares owned by institutions. But if you look at the top 5 MSOs, you have less than 10% that are actually owned by institutions. And this will change over time. And as institutions come into the market, that simply means more capital is coming to the market. And with that capital, it will drive prices of everything higher. And that's your basic supply and demand. So we are in an opportune time to take advantage of high growth, lack of capital, and limited institutional involvement. So for us, it's the perfect time to execute on our strategy. And we do have Quite frankly, we have a number of tailwinds in the marketplace that should continue to bode well for the industry and specifically for the fund and our investors. First is the idea of rescheduling. As I mentioned earlier, and I think probably most of you know this, but cannabis is a Schedule One controlled substance, and what that means, and to kind of put some perspective into this, is a Schedule One controlled substance besides cannabis also includes heroin and LSD. So you have very potent drugs, and in the eyes of the DEA, is a drug that has no medical benefit and has a high addiction rate. So cannabis has been scheduled as a Schedule One narcotic since the 70s. There's been a recent movement under the prior Biden administration to push the Department of Health and Human Services to look at cannabis for its medical benefits. So the Department of Health and Human Services came back and made a recommendation to the DEA, who actually has oversight on the level or scheduling or rescheduling of controlled substances, and made a recommendation that there is medical benefits and that it should be rescheduled from a Schedule One to a Schedule Three. That should have occurred last year. There were a couple of missteps on a number of different parties that got punted until early 25. Now, as it stands, it's kind of unclear exactly when that rescheduling will occur, but should it occur, which we believe it will, that'll be a big tailwind for the market because it will open up and allow additional businesses to get involved, but it won't allow banks because it still will be federally illegal. So banks still are not going to traffic. Another tailwind would be, we'll call it a Garland memo or a Pamela Bondi memo, some memo from the U.S. Attorney General that provides direction should cannabis be rescheduled from a Schedule One to a Schedule Three. And there was a Garland memo that was in effect for a while that essentially defunded the Department of Justice from going after any legal operation in a state legal jurisdiction. So it defunded the Department of Justice. And then as we continue looking at the state legalization, currently we have 41 states today, including DC and a few US territories, that have cannabis on at least a medical basis. If you look at just the adult use consumption, that number's at 24 states. So we'll continue to see these grow. And when they do, again, going back to the fact that you can't cross state lines, you'll see the total addressable markets or demand for cannabis continue to increase over time. Add to that a recent Pew Research survey found that 88% of Americans believe that cannabis should be legal for either medical or recreational purposes. So broad-based consumer support across the board, not in its entirety, but 88% of Americans specific in this survey found that it should be, or at least thought that it should be. And the last is the notion of uplisting on exchanges. Currently in the market, most of the cannabis companies have dual listing or list it within the Canadian market. And when you list in the Canadian market, it's a thinner market. There's not as much liquidity and there's not nearly as much institutional involvement as there is, say, on the New York Stock Exchange or on the NASDAQ. So this idea of having companies be able to uplist on US exchanges would significantly increase the benefit and liquidity profile of all these companies. So these are tailwinds in the market that ultimately will play out over time. Maybe one or two might get slowed down, but generally speaking, there is a tremendous amount of opportunity and tailwind as we look forward to the coming quarters and even years. So how do we capture this opportunity? Our investment strategy, quite simply, we originate debt and equity securities or transactions to finance cannabis companies. And when we do so, and I'll talk about this in greater detail in a second, is that we use what's referred to as an alternative use valuation. Said differently, we assume that cannabis goes away in every transaction, and we need to bring in, let's say for a dispensary, a Verizon or a Starbucks. What could we sell or lease that property for to that alternative use tenant? And so that, and I'll talk a little bit more as I mentioned, but that keeps our valuations on the lower side. So in the event, if that tenant were to default or move out, we don't have a lofty valuation that we need to require a new tenant to come in and fill because our valuation is much, much lower. And from our investor value proposition, we help accredited investors with exposure to the real estate market within cannabis and focusing on above market income as well as price stability. So what you get with MJ REIT, you get the ability for us to traffic primarily in the private real estate side. But should we see an opportunity, we do have the ability to allocate some of our portfolio to the public market. So what you get is essentially the best of both worlds with, again, this idea that our main focus, we are intently focused on price stability, and I'll show this in a second, as well as that above market income. And on the price stability standpoint, lots of numbers on this page, but if you look at the performance on the top, that's our monthly total return. But I want you to focus specifically on the bottom at what's labeled the transaction price. That's our price per share per month going back since inception. And what's interesting about this is we launched at $25 a share, and today we are priced at $25.16. So we've had a steady net asset value over time, and our investors have done well with that consistent return that you see above. But when you look at the monthly income, so we have this stability of principal that I just mentioned, but in addition to that, what we're focused on is a 10% targeted total return derived mostly through monthly income. And so what I thought would be interesting is to take a look at our monthly annualized distribution since we launched. And what stands out to me is the consistency. You'll see a couple of bumps in months where they're 15+% on an annualized basis. But generally speaking, we've been right around that 10.1, 10.2, all the way up to 16.67. So we've exceeded our expectation and our goal every month since launch. And if you look at those 3 months that stand out as outliers at 15.5, 16, and just above 15, those were months when we had a sale in the portfolio. And because we're taxed as a REIT, any additional income that we receive, we simply pass it along to our investors. And in doing so, that caused our annualized distributions to bump up quite significantly during those months. And it was an added benefit for our investors. But keep in mind, because we are taxed as a REIT, there's an additional tax advantage. And that tax advantage is any distributions that we pay. And again, we're paying almost all of our return is derived from distributions. Any distribution that we pay is taxed at only 80% on the federal level. So said differently, you're only paying tax on the federal level on 80% of the distributions that we pay you. So you get that additional bump in valuation. The chart on the left-hand side, assuming we paid a 10% distribution, the taxable equivalent yield, if you're in the highest tax bracket, is at 11.2%. So you would need to go out and find, let's say, a taxable corporate bond at 11.2% to earn what we're paying on a tax-adjusted basis. So we've had stability, and we've also had consistent above-market monthly income. And then the growth over time, we've continued to see a nice growth. Should come as no surprise with the numbers I just showed. So a $100,000 investment at day one would be just under $130,000 today. That equates to an 11.4% since inception return. Our most recent month was the month of January. Just as a side note, we have monthly distributions. We value the fund on a monthly basis, monthly purchases, and monthly redemptions. And so our distribution is paid by the 15th following month end. So our January distribution was paid on February 14th, in line with all the prior months, and that annualized at 11.02%. And importantly, all the distributions that we've paid since inception have come exclusively from the interest that we've earned off the loans that we've made. So we're not returning as a return of capital to make it appear that you're getting a higher income, because that simply erodes the value of the fund and the principal of your investment. So all of the distributions since we launched are 100% from the interest or rents that we've received off of the investments that we've made. This is a slide I want to spend a little bit of time here to really outline our relationship with our sub-manager. It's important to keep this in the context of the ones in the marketplace that are actually diligencing the deals. They have a vast network. of individuals that are looking for capital is a group called Rainbow Realty Group. So you'll see that on the right-hand side in the green. Rainbow Realty Group is a part of a broader family office called Gould Investors out of New York. Now, Gould has been in the real estate space for about 65 years and has thematically invested across those 6+ decades. So think movie theaters, parking garages, maybe mobile home park, garden style apartments. And they identified cannabis as an opportunity in 2014 and ended up financing the first medical license in the state of New Jersey. Won that license and then quickly realized, as part of the group they were with, that they're not operators, they know real estate, and they looked at cannabis as a way to take advantage of that growth and lack of capital that I mentioned earlier, but in doing so, underwriting every property with an alternative use valuation. And that's the key difference between what we do and every other financier in the cannabis space is we use an alternative use valuation, which I have a slide on specifically to bring it to light, as opposed to a valuation that includes the bump in value associated with the cannabis license overall. So Rainbow is what's referred to as our sub-manager, and they're the ones in the market on a daily basis looking for deals to ultimately diligence and put those in the fund. Every deal, and this is unique, you're not really going to see this type of depth in an investment committee at other shops, but if you look at the investment committee that we have a 7-member investment committee with collectively over 200 years of experience in real estate, whether it's deal structure, legal accounting, or other areas of the real estate market. They've dedicated their entire careers to the real estate area. So we're fortunate to have not only Rainbow and the team looking for these deals on a daily basis, but then all those deals are vetted by a very seasoned and experienced investment committee. And with those deals, we will lose a lot of deals in the market. We don't win every deal, and we don't intend to. If you look at 100 deals that we analyze, we're going to fund maybe 1 or 2 of those deals. You think your building's worth 10 million. I think it's worth 5 million. You want to borrow at 8. I want to lend you at 12, and we just can't come to an agreement. Or we find other items within our diligence that weren't necessarily properly disclosed. And so out of every 100 deals we'll look at, we'll close on 1 or 2 of those deals. So we're very selective on the deals that we actually put or fund in the portfolio. And you don't really necessarily need to go through all of this, but understand that we have a vast network and market because a risk really is we can't find deals. And how do we mitigate that risk? Well, we have a vast network of brokers, lawyers, accountants, company consultants that call on us, other lenders, our general marketing, the brand overall. And in this funnel of individuals continue to cycle deals our way. And then the deal sourcing process is somewhat complex. Most of these deals that we see, as I mentioned on the prior page, don't make it all the way to the deal close. So it'll drop off at some point along the process. And the concept of alternative use valuation, I wanted to hone in on for just a second. I thought this slide was good in outlining visually what I'm referring to when I say valuation. So let's assume that everybody on the phone, we all get together and we buy an industrial building for $2 million. And our goal, we got a cannabis license. We're going to grow cannabis to sell it to a dispensary. So we buy the building for $2 million. We may have to put $6 million of improvements into that building. Think of HVAC, irrigation, lighting, high-tech security. So in our minds, we bought the building for $2 million. We put $6 million into it. So now the valuation is at $8 million in our mind. And there are firms or were firms in the marketplace that would come up with that $8 million valuation. But here's the risk. What if that cultivation firm goes out of business and you value that building at $8 million? Well, you're stuck because you need to find another cannabis tenant willing to pay the price per square foot to get that valuation at $8 million. And when you do that, the number of potential tenants shrinks. And so the way we look at it is we come in and we say, okay, we assume that cannabis goes away. And quite frankly, the next non-cannabis tenant may not have a need for 14 air conditioners and state-of-the-art security. So we would come in and value that property on an alternative use basis, give the borrower no increase in value for those improvements. And we may come in at 2 or 2.25 million, with the idea that if that tenant goes and fails or defaults, now our valuation is significantly lower. And so we can go out and find a non-cannabis tenant to fill that spot fairly easily versus trying to seek out solely a cannabis cultivator where the numbers are limited. So that's the critical difference in what we do versus other financiers in the marketplace, is this notion of alternative use valuations. And from a deal standpoint, very quickly, since launch, we financed 28 properties across 5 states. 3 of those have paid off uh, with very attractive IRRs. So if you go back in your mind to when I was showing the monthly annualized distribution, this is the reason those distributions were higher. We had 3 properties that generated somewhere between a 31 and a 62% IRR. And again, once we get that additional income from the sale of those properties, we simply pass that along to our investors as additional income on that particular month. So we don't hold that capital back. Our current pipeline exceeds over $100 million, and it's pretty much a national basis. So we'll traffic in any one of those 41 states that I mentioned. So we'll go into any state legal jurisdiction, because again, it's not so much the cannabis necessarily, it's really the focus on really the alternative use valuation. So if there's a good industrial property at an attractive valuation, whether it's in California or Maryland or Maine, we'll take a look at that property for inclusion inside of the portfolio. All in, I just put a couple of the deals that I showed on the prior page. So we have highlighted 4 deals across California, Colorado, Connecticut, Arizona, and Nevada. So it's all in, we're a little over $30 million that we'll put into the market. We're in the final stages with all of these companies. We'll probably, I don't know if we'll fund all of these, because maybe there's another wrinkle before we actually go to closing. But point being is that we have a very robust pipeline, and we're extremely active in a limited market where there's simply not a lot of other players. So we can be very selective in the capital that we're putting out into the marketplace. And then how do we exit these loans? Really, I would say really mainly, I put 4 down here. It's really the first 2 that are most likely. And the first is that the property is sold. And that's what happened in the case of the 3 payoffs that I showed on the earlier slide. Property is sold. From the proceeds, our loan is repaid. Second is that the borrower finds an alternative financing from a different source and refinances us out. The third and fourth, probably lower on the active space, but occasionally occur. And that is the borrower simply pays us off with free cash flow, or there's some sort of equity infusion that comes into the company, and then we're taken out as part of that transaction. But mainly we are paid off either from the property being sold or the borrower refinancing with a new lender. From a biography standpoint, this is the team that's in the market every day working, and not the whole team, part of the team that's in the market every day working to find deals, fund deals, and ultimately manage MJ REIT. So it's myself, my partner, Gopa Dobson, Kyle Schenfeld, who is the CEO of Rainbow Realty Group, Matt Gould, who's the CIO, and Ben Balanis, who's the Chief Operating Officer. Long backgrounds in finance, legal, and real estate. So this is the main team that's focused every day of running the portfolio. And what makes us unique, and I put this in, and it probably will make sense as I highlight these, because it's really what we've talked about. Number one is we get cannabis real estate. Cannabis real estate is a unique area in the market, and it has much different requirements than other areas of the real estate market. And every state has different regulations. But this is all we do. We focus 100% of our time on the cannabis real estate sector. So we're experts in this area, and we've done this before. So we've been currently have exposure to 25 properties across 5 states. And we have a 7-member investment committee that vets all of those deals. And then lastly, we're meticulously focused on risk mitigation, and we don't like risk. So how do we mitigate as much risk on the upfront to ensure a favorable outcome, even if the borrower gets into trouble, even if they make a misstep and we have to come in and foreclose. Again, getting back to that valuation being the most critical aspect. If we don't strike a high valuation, our ability of having a successful outcome for our investors significantly increases. Why do our investors tend to allocate to us? The income obviously is a big component. Most of the investors we have use us for really one of two things. One is a diversifier on the real estate side because they have exposure to multifamily or residential, and they look for us as a diversifier within their real estate bucket or as a fixed income alternative. They have a need for income, and the attractive above market income that we've been paying fits nicely into their income generating bucket. We are a diversifier. Some investors use us to just escape the public market volatility. Because if you look at the returns that we're deriving, they are kind of equity-like returns. If you look at not specifically the last 2 years, but if you look at the public equity markets over a longer period of time, we're kind of generally in line with the overall total return. And then the tax benefit that comes with the distributions. I do have an independent board of directors, a great group of individuals. So it's myself as chairman of the board, Matt Gould, who's the CIO over at Rainbow, Michelle Gillespie, Matt Malone, and Jeff Mylock, all extremely bright financial individuals that provide a significant amount of guidance and direction. So I'm very grateful for their involvement. And then just in a summary before we take some questions. So why now? I look at the ability for us to continue to execute on our strategy really as a timely opportunity. This is not necessarily an area that we can take advantage of for the next 20 years. At some point, banks will get into the space, and instead of lending at 13 or 14 or 15%, we're going to have to lend at 9, 8%. And so we will see that over time. But right now, and as we look out through the next 5 or 7 years, it looks very favorable as a status quo in the market with no big changes that would allow banks to get into the marketplace. We take an institutional approach to the real estate side. We have no capital calls in the market. So whatever capital that you deem you'd like to invest, you invest with us. And then we have that liquidity program that whenever you want to create your own maturity, you simply tender or redeem your shares and we send you your capital back. I will note we do have 12-month, although it's not a lockup, we do discourage short-term trading in the fund. So if you choose to redeem in the first 12 months, you exit at 95% of the then current NAV. And then a 5% haircut really is intended to discourage short-term trading. We have a stable net asset value, our above market monthly income. From a tax standpoint, really easy. We're no K1s. We just provide a 1099. We focus on risk mitigation, and the minimum investment is low. So when I launched the strategy, I wanted to make it as freely accessible to as many people as possible and not just have QP type investors where you're going to commit $5 million. This is an area that I believe that everybody should have the opportunity to take advantage of. And as such, we put the minimum at $25,000. Let me look at some questions real quick. So we have a few questions that came in. First one, when you look at the distributions, if you choose to reinvest your distributions, can you do so? Good question. So yes, short answer is yes, you can reinvest in additional shares. We do have a DRIP program available. That DRIP program allows you to reinvest at 99% of par. Really, it's a 1% bump in valuation for you. And next question, we look at some of the public companies. What do they do and why have they done so poorly with trend to more and more states allowing cannabis use and with the general public looking at its use more favorably. So two companies in particular, I won't comment specifically on my opinion of those two particular companies. I will make a general statement. If you looked at the cannabis market overall and go back to 2019, the cannabis market, as well as most public markets, move on anticipation of future events. So what's expected versus what actually occurs. So in 2019, there was a lot of hype around the idea that cannabis would continue to move favorably and be legal on a federal level. That would increase the number one, it would do away with the 280E tax consequence that we have. And also, number two, it would allow movement across state lines. It would create a lot of additional noise in the marketplace, or opportunity, I should say, in the marketplace. And you saw shares of Tilray and a bunch of other publicly traded companies shoot up. And at one point, Tilray was trading at $60 a share. That stock fell from 60 down to $5, actually a little lower. And so there's been a lot of volatility. And on the public side, investors haven't really done well overall. And so when I look at this particular area of the market and the strategy overall, we didn't want to take a direct exposure with an operator, but rather we wanted to focus on lending on a a hard asset, with the real estate being the crown jewel. So we started this strategy really to take advantage of high growth, lack of capital, with this idea that we're going to focus solely on real estate. And that focus solely on real estate allows lower volatility in the market. Can these shares be held inside of an IRA? So yes, I forgot to mention that. So we are available on both qualified and non-qualified accounts. We have a relationship with a handful of self-directed IRAs. We do have a number of clients that utilize us on the IRA space. In terms of banks entering the space, do you see lower borrowing costs boosting the value of real estate that you have invested in? Good question. So at some point, definitely banks will come into the space. It's in any maturing industry, the opportunity will eventually mature. Rates will come down. Along with that, competition will increase. That should boost the value of our properties, but also understanding that in most of these circumstances, we're simply providing the mortgage, so we would get refinanced out. And over time, and this is my comment on being a 10-year strategy, we're taking advantage of an opportunity in the marketplace that's outsized because of that difference between the state and federal markets. So you come into the funds, you hold it for 2 years, 3 years, 5 years. All of a sudden, we see that we're getting legalization on the federal level. Rates are going to come down. You have the ability to exit out of the portfolio. And not that the strategy goes away, but that additional enhancement in taking advantage of that dislocation probably will be watered down. And maybe we have a return a little bit lower. But also keep in mind, I have zero leverage in the fund. And so even if rates come down, we could lend at 9%, and I could put 0.5 to 1 leverage on the portfolio and still be able to meet that 10% targeted distribution. If cannabis ever becomes legal on the federal level, what might that mean for MJ REIT? Well, we would still be active in the marketplace, but really that additional enhancement in returns probably would drop. And instead of having a return of 11.4, we'd probably be closer to that 10% overall target return. And so it's still a viable strategy, but that outsized return may not be in place for 20 years. And again, going to this opportunity, why we believe now is the right time, because that difference between the state market and the federal regulations, and the fact that banks can't enter this space to any great degree, that gives us the ability to step in and provide this vital funding for these companies to ultimately to grow and to profit. And so, yes, the rates would come down over time, but on the flip side, we simply act to be a component of your diversified portfolio, and you hold us for as long as you want. And then if you find a different opportunity in the marketplace, then certainly you have the option to redeem out and move on to another investment. Okay, so I think that completes all the questions. Listen, I really enjoyed the presentation today. Hopefully you found the information helpful. Just as a way of follow-up, it'll take a little while to get a copy of this back to you, but we'll send out a copy of the webinar, and then also we'll send you an email just by way of follow-up. Always happy to answer any additional questions that you may have, and always available for additional conversations. So with that, I sincerely appreciate the time. I hope you have a great day, and we'll be in touch soon.